Energy prices may have eased a bit, but so has consumer spending, leading to the biggest drop in consumer prices in decades. The stock market continues to test new lows as economists agree that the U.S. has entered a recession, one that's likely to last well into the new year. For long-term investors, this is about as challenging as it gets when it comes to staying the course. Brian Koble is back with us today. He's Senior Research Analyst at Hefren-Tillotson, which is a sponsor of our Regions Business. And welcome. Good to see you again.
Good to be back. Thank you.
Yeah, we're coming up on the new year. It probably feel good to everybody to put 2008 behind us.
2008 has been one of the worst years for the stock market, and it probably will be the worst year for the stock market since the Great Depression.
Wow.
And it's been a very frustrating year for investors, particularly since these kinds of years typically only happen once or twice per generation. And now we've had two of these terrible bear markets just this decade. So it's been a very disheartening period for investors. I think particularly because many people got burnt badly during the tech bust from 2000 to 2002, and they thought they learned their lesson, and they did all the right things this time, and yet they've still faced substantial losses. Part of the reason for that is because virtually everything has gone down. There have been few places for investors to hide. Typically in a bear market, you have some things that go up, some things that go down. This time it's been like pulling the drain in a bathtub. Everything has fallen, and it's been a very frustrating year for investors.
Yeah, I guess no safe havens other than parking your money in a money market fund. And heck, there have even been some doubts about money market funds a little bit along the way. It really is an extraordinary time. And as you say, just as investors were kind of getting their confidence back. So what do? You're exposed out there right now as we kind of head into the new year. How do people begin to plan for that?
Sure. Well, I think the first thing, when you get your investment statement, don't panic. A lot of people will have some nasty surprises in terms of the losses they've experienced. But we've seen few people over the years make good investment decisions based on panic. And at the same time, we've seen few people make good investment decisions by sticking their head in the sand. So you want to be informed. You want to take an analytical approach towards your financial situation. And I think we can kind of segregate people into two different groups. You have folks that are in the accumulation phase. In other words, they're 20 or 30 years from retirement, and they have a long time horizon. For those folks, this is certainly an excellent buying opportunity. And to the extent they have liquidity and they can put money to work, they should. Or
as you put more money into your 401k, start thinking about those more growth-oriented investments. You have plenty of time to make them work.
Exactly.
Yeah.
Things become more tricky, though, for folks that are in what we call the preservation phase of their investing life cycle. That is, folks that are on the cusp of retirement or who have already retired. Because they can't cope with another large decline in their portfolio balance. They might not have the time to recoup. So what do they do? For those folks, we typically recommend what we call a cash flow matching strategy, which is really very simple. And all it entails is if you have short-term spending needs, that money should not be in the equity market, because as we've seen, the equity market can go down over a short period of time. That money should be in cash because you know that cash will be there. Okay? If you have intermediate term spending needs, let's say over the next 2 or 3 or all the way to 7 years, that money shouldn't be in the stock market either because the stock market can decline over that period of time. That money should be in bonds, okay? Because you get a higher return than cash, and you know that money's going to be there if you do your homework. Bonds are very safe. It's only for the long-term spending needs that you have, needs that are 7, 10 years out and beyond, that should be in the equity market, because you can hope, based on history, that the equity market will return higher rates of return than cash or bonds, and you can hope, based on history, or have a reasonable expectation that equities will rebound over the course of 7 years from any losses that they've experienced.
So it sounds like the best thing, it's holidays, hopefully things slow down a little bit, take out the pencil, or if you're computer literate, hit the PC, and really do this kind of analysis and sort of do your own mapping to figure out how you should be invested most effectively.
Again, I think you make a great point. You have to crunch the numbers and make an informed, analytical decision. You can't make an emotional panic type of decision.
All right, Brian Koble from Hefren-Tillotson. Thanks so much. Appreciate it.
Thank you.
And next up, Pittsburgh in pictures from 1758 to today. Stay with us.